What up, guys? It's August 17, and let's go over an interesting stock idea that I came across for your portfolio and my portfolio. Okay, so stocks come to me all sorts of different ways. This stock came to me by reading Morgan Stanley's list of deflation enablers for the second half of 2022. So I was interested in companies that will enable deflation, that are good in automation and reducing specifically wage inflation, which is I think what this company will do. Okay, before we get started, of course, please hit that like button, hit subscribe. Hopefully you learn something from these videos and we have some fun in the meantime. Okay, let's get on with it. All right, so the company I'm talking about is called SmartRent. Okay, and they're listed on the New York Stock Exchange under the symbol SMRT. All right, so you can look in your brokerage and look for all the research on this stock. I definitely encourage you to do your own research and make your own decisions on the stocks you want to buy. But I want to go through my train of thought on this stock and the work that I've gone through so far to make a decision to put the stock in my bullpen. Okay, it's not a perfect stock by any means, but I hope that you learn something from my method here and add something to your own method. So we always start with, what does the company do and the business itself, right? So we do a business analysis. We don't go to the valuation. We don't go to technicals. We don't go to any of that. First, we're going to talk about the business, and we're going to see, do we like this business? And I sure like this business a lot. I think it has a lot of potential, a lot of explosive growth, okay? But what you're seeing here on their investor presentation for Q2 of 2022, they're going to show you what they do, which is essentially software, hardware for apartment complexes, restaurants, for hospitality, for hotels, but mainly we're talking about apartment complexes. This looks to be the vast majority where their business comes from, okay? So leading solution provider for owners and operators. It has a large addressable market, highly visible pipeline of demand, significant growth opportunity, and attractive financial profile. All true, in my opinion. Okay, now moving on. This is something that I like that companies do. They tell us kind of where they stand. The figures that I'm looking at here are the Q1 key performance metrics. Okay, and then that's the amount of units deployed, meaning the amount of apartment complexes or essentially customers that they've deployed and the customers they've booked, okay, and then what they're committed for so far, okay. So right now they have 1.8 million devices installed. I'm not sure if that's one device or one customer or a lot of devices for one customer. I would guess that's a device or devices, in total for all customers, okay. 390,000 units deployed, 731,000 users, okay. So this is probably going to be the customers themselves and the tenants of these customers as users, okay? So don't let that mislead you. This is what they're probably referring to here, okay? They're saying 5.1 million unit opportunity from existing customers. So again, don't put a lot of faith in what they're telling you on these slides, especially when they're trying to sell the business to you, because a lot of times that's what they're trying to do, okay? Right now here they're talking about competitive advantage. I'll talk about that in a little bit because I think the competitive advantage is medium at best. That's called a moat, and I'll go over that in a second. But the moat is sort of medium at best because there are security companies out there that I think don't have a huge barrier to entry to provide a software solution for apartment complexes to monitor everything that they do, okay? Now, here they're showing you essentially, and I want to go to this slide here, flexible product offering with expansion opportunity. So these are all the devices that they're placing in these apartment complexes. And of course, it's not only apartment complexes, but that's what we're using for this purpose. Okay, so we're talking a lot of locks, sensors for leaks and things like that. Thermostats by Honeywell. You see Honeywell Wi-Fi as well. So they're using a lot of Alloy branded products, Honeywell branded products, and Ring branded products. Okay, so these are not proprietary to them, right? They're proprietary to their, Ring belongs to Amazon, Honeywell is its own publicly traded company listed on the Dow Jones, and Alloy, it's its own thing. But they're saying, hey, we're going to sell you these products, these third-party products, but we're going to provide to you the software to connect all of these and make sure you, as a property owner, can manage all these devices and make all kinds of decisions as to empty apartments, occupied apartments, or apartments in transition, etc. Okay, for maintenance, administrative, all kinds of things, which I kind of like because it brings technology through software to one single point of sort of control, or maybe a couple of different points of control, thus eliminating a ton of work necessary by other folks. So this is automation that does get rid of jobs, okay? But that's why Morgan Stanley said this is a deflation enabler, which means it cuts jobs and it's automation essentially, which we need a lot of nowadays with the rate of employment the way that it is. Here in the next slide, they're talking about essentially what I just told you guys, right? So self-guided tours through an app, building access control, video intercom through their Ring devices, okay, Wi-Fi control, and overall smart apartments for tenants to control their ACs, whatever, their IoT devices, Internet of Things devices like microwaves, alarm clocks, Alexa devices, right, Google devices, washers, dryers, etc. You think about it, like I said, everything has a chip in it, right? Everything that can be controlled with a chip in an apartment, they're trying to make it controlled by this app and provided to you by the apartment operator, okay? Also, smart parking, I think, is seems kind of annoying, but very nice if you're an apartment operator. If you go park an apartment and you see one of these devices here, what do they look like here? These little pods, and you're just like, man, I can't park there because it has a pod, and then I'm gonna get towed. That's what these apartments will do when they have these pods. They're trying to tow you. So moving on. The next slide here, not too crazy about it, but they're talking about the acquisition of SightPlan. I think they talk about it in a slide further down, but they're saying, look, we're adding some more features to our software through the acquisition of SightPlan, okay? And we're talking about lease signing and administrative options for that come from SightPlan. And here we see here, essentially, they got call centers that people can call to and engage with the tenant, schedule work, inspect buildings and service areas and tenants' rooms or apartments, and administrative auditing. Okay, so this is what SightPlan is adding to their suite of software to make the product more of a one-stop shop for apartment operators. Here on the next slide, they're telling you, hey, we can cross-sell a bunch of people now with this acquisition. Remains to be seen. If you look at the income statement, very much remains to be seen whether you can cross-sell or not. So don't buy that there. And then here, SmartRent delivers undeniable value to owners and operators. So here's an important part of their business, okay? They're saying, hey, here's our value to the business. So you're going to save on utilities and staffing. That's what we're talking about. That's deflationary, 20 to 30% savings on utilities and staffing. So essentially they're telling you, hey, water, power, sewer, trash, we're going to save you on all that stuff. And also you don't have to staff as many people, so you can let go of some people and increase your bottom line. That's probably very attractive to apartment operators and owners. Okay, also asset protection. So if you have washing machines on premises or washing machines in the actual apartments, we'd be able to install these sensors. So if any leaks happen, we protect these assets and you don't have to buy new ones for your tenants. Also over here, decreasing water damage expense. You guys know about all that. Okay, now revenue generation. They're saying, hey, we can actually increase the rent per unit by $25 to $100 a month, bringing higher rents, higher revenues, higher bottom line, and then 20 to 50% decrease in leasing costs. So this is essentially their value proposition, which I do agree with. I can see this very much helping a operator save money and increase their bottom line, which makes the product worth it. So moving on, not much else to kind of talk about here. They're talking about water management and their sensors and how they help those value propositions here. Their total addressable market, I don't pay too much attention to their predictions of total addressable market. I'm sure this is not going to go from a $1 billion business to $200 billion. Hopefully it does for existing shareholders, but I very much doubt that. When you have a medium-sized moat barrier to entry, I don't think that's possible. That's kind of pie in the sky number right there. Okay, now industry leaders are saying, hey, look, all these companies have chosen SmartRent. Great. And here's all the owner managers that are using it at the moment. Excellent growth in customer base, looking good. Also here, talking about organic revenue. Organic revenue looks fine. Revenue growth, and then sales cycle, don't care about that. And then here, units deployed, booked, bookings, committed units, total units deployed, and total units deployed and committed, all looking amazing, looking at great growth. Okay, now, here's their main problem, okay? So we're looking at total revenues increasing quite healthily all the way from last year, first quarter 2021 to first quarter 2022. Very healthy increase. SaaS revenue, that's software as a service revenue also increasing quite healthy. However, here's the horror story, guys. You got that gross profit just dropping down. So pretty much dropped down significantly, up a little bit, but right back down. So not profitable, and earnings nightmare, EBITDA nightmare. Earnings before interest, taxes, depreciation, amortization. So this is the money they clear after spending all that, and earnings are just going down, 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 down. So we'll explore the income statement a little bit to show you why that's happening. Now here, as a business summary, I wanted to show you guys here. We went through pretty much what it is: smart home, smart building automation. Okay, this became public via SPAC. Okay, so when I see this word SPAC, I start to get afraid. My ears start to pop, and I red flag that stock. Okay, so SPAC, special purpose acquisition company. These are companies that became public, most of them in late 2020 and 2021 in the SPAC attack craziness that happened in the market. Most of these companies became public through what's called a reverse merger or a SPAC, and they're companies essentially that have no revenue growth, promise of a business, not a real business, okay? And you've heard companies like Virgin Galactic, you've heard companies like Lordstown Motors, companies that have no immediate product to sell to a customer, and they're selling like the business is booming already. So these are companies that you have to be very, very skeptical of valuation, and that's why I put a red flag by it. So we're going to be very skeptical about the valuation on this company, okay? So we've talked about what the business is: provides software and hardware solutions to all these places, complexes, real estate, commercial buildings, etc. The software, which allows the control of hundreds of thousands of edge devices from one place. And the value proposition, we saw the value proposition: folks will pay more for a rental apartment that is more technological, okay, decreasing costs, protecting business assets, and decreasing the complexity of running an apartment complex, okay? Business does have a path to explosive growth in the next 3 to 5 years. I don't think there's any question about that, okay? It's, of course, deflation enabler. We talked about that by Morgan Stanley. And it's a business with extremely minimal churn, which is quite surprising, okay? That's actually a point of strength that I like about the business. There's literally no churn on the business. So it means they're not losing customers pretty much at all. Maybe onesie or twosies here and there, but compared to the number of clients they're signing up, the churn is essentially zero for this business. So it shows a sticky product that customers cannot get rid of that easily. That's a good sign, okay? We have a competitive moat. Barrier to entry, which is medium. We talked about that. It's not like a high barrier to entry, kind of like a Facebook or an Apple, in which no other company can just go replicate that business. I think it's probably a medium difficulty to replicate this kind of business, okay? And insane growth rates, guys. Insane. We'll talk about those in a second. Now let's head on the fundamentals. This is the second part of what we looked at after we look at the whole business overall. Pretty much the business, I like it. I think that it has promise, it has potential. I like the products. I think the Honeywell products are really good. I think the Ring products are really good, and the software they have to connect those to one-stop shop is a pretty good idea for apartment complexes to make them more enticing for tenants. Okay, but now we're moving on, and we're looking at the balance sheet. So $255 million in cash and debt of $7.9 million. That's an A-grade balance sheet. So excellent capital position for this business. But then we get to the income statement. That's when we start seeing some trouble for this business. Okay, we do have revenues that increase 50%, about 50% in year-over-year basis on Q2 of this year from Q2 of last year. So that last year, Q2 2021, 21 million, and they doubled that to 42 million. However, we look at their cost of revenue, and it's costing them about the same, 50% more expenses than the same time last year. So they're pretty much breaking even right here. They're really not doing anything with those increased revenues. It's costing them so much more to do that. And I'm thinking it's because they're a fairly new business that needs a lot of upfront investing here. And we can kind of see here that that's what they're doing, because they're doubling their rate of research and development. I do like a company that spends a good amount on research and development. SaaS companies, software as a service companies, need to spend on research and development to get better, because they need to constantly change to suit the needs of their customers, which are probably ever changing. Sales and marketing, almost threefold increase on sales and marketing. That shows that essentially they they want to put their name out there, and they're trying to do a better job at it, okay? And then at the end of the day, total operating expenses pretty much almost tripled here, 180% increase from 10 million to 28 million, operating at a loss, and net loss of 25.5 million. So this is not a profitable business, okay? EPS equates to a loss of 13 cents per share for 2022 GAAP metrics, and the recent guidance that they give us has been very, very much lowered, like disastrously. Like it's a disaster the way they lowered guidance for fiscal year 2022. Okay, we have revenues down, EBITDA, the earnings down like by 50% about, and then the amount of units down by about 35-40%. Just a disaster on the guidance. So we'll see here the action of the stock, and if you see the year to date on this stock is just a nightmare. Just nothing but down for this stock. So of course it does reflect that. And then here, if we're looking at let's see here, a 1 month basis, this is the market's reaction to them lowering guidance that way. Remember how we talked about this quarter, everything is about guidance. They lowered guidance significantly. Market punishes them severely. So from a fundamental basis, not good. I don't like the guidance. I don't like where the business is going as far as the path to profitability. We can see the path to profitability go the opposite way. We want it right over here, guys, right? So we're expecting bigger losses than before by about 35-40%. That's the wrong way, guys. So the business is not going towards zero or break even. It's going the other way. Not good. That's why the stock was punished. Now, moving on. We got the valuation here, and when I talk about valuation, the metrics that I like to pull up are the Yahoo Finance metrics. So these are the same that you'll find on Yahoo Finance, and it makes it easy for me to explain because there's good and bad about this, okay? So you'll see the stock valued right now about $723 million on the stock market. That's the market cap. No PE metrics, okay? When you see no PE metrics, it means not profitable. There are no earnings. So there's the price and the earnings. There are no earnings to measure, okay? I know I'm covering the E there, but there are no earnings to measure. Also, price to earnings growth. Nope, there's no earnings, so that's NA. So the best way we actually look at a metric to price the stock is the price to sales, okay, which is about a little bit under 5, okay? So price to sales is the only way that you can, in my opinion, that you can really value an unprofitable business, or it's the easiest way, let me say, to value an unprofitable business. But we have to look at the revenue growth for 2022, 70% revenue growth. That's amazing. I think that's going to lower later. I don't think it's going to be that. I think it's going to be closer maybe to 50% revenue growth. And then 2023, 83% revenue growth. So analysts, at least 8 of them, are expecting the revenue growth to pick up in 2023. So when it comes to the valuation of the business at $3.70, it may look cheap, but I think $1.90 or less is the buy point where you start a position on the stock and you can build it significantly. But you have to wait. You have to wait until this company becomes profitable, or at least some sort of crazy short squeeze takes you into the $10 range, okay? So you can pretty much double, triple, 5x your money here over the next 3 to 5 years, okay? So now moving on. Let's talk about technical analysis or market sentiment. So we're going to talk more about market sentiment. I don't talk about technical analysis a lot because it's my least favorite way to value a stock. I think if you're valuing a stock on technical analysis, you're just doing it all wrong. But technical analysis, I think, is impossible on a stock that's been in the market for a little bit over a year. So not doing technical analysis for SmartRent, okay? But we're talking about the market appetite. The market has a low appetite for stocks like SmartRent, okay? So unprofitable tech stocks, the mood of the market, pretty somber. Okay, if the price of energy and inflation remain high, unprofitable stocks like Smart are going to remain no touch for investors and Wall Street firms. It's the market has no appetite, okay? The Fed, when we're talking about the Fed stance, again, one of the things I've learned in these last couple of years is how important the Federal Reserve is to your investing. And right now, in a hawkish stance with quantitative tightening, that's the reduction of cash, of liquidity in the overall economy instead of the enhancement of liquidity, it's no good for Smart. Okay, so companies like Smart in a hawkish and in QT stance or the Fed, not good. It doesn't look good for stocks like that. Okay, and then the overall opinion is that it's still overvalued, but I am watching it, definitely watching it. Okay, it's a nice business model. Stock price seems reasonable, but highly overpriced still, or slightly, excuse me, given the market appetite for the SPACs, which are unprofitable. So right now, sentiment-wise, no bueno, no good, no touch, unless it gets severely demolished to a price in which you go, man, this price is silly. That's the only time you can pick up a stock like this, when the price is just absolutely silly on a 3 to 5 year basis. And that's not yet there. It's almost there, but not yet there. So that's going to be it for today, guys, on Smart. Okay, I hope that you like videos like this and the kind of analysis that goes into making a decision of buying a stock. Let me know if I can help you with anything. Hit me up on IG, Twitter, Discord chat. I'll leave the links below. Peace out.